Let me talk about some examples just to try and make this real. And I want to talk about examples from my neighborhood. I was born and raised in Vancouver, lived there my whole life, and have been an entrepreneur my whole life and an angel investor for about 25 years. So I've seen a lot of the transactions in my backyard and gotten to know a lot of the angels and a lot of the entrepreneurs fairly well, which gives me a pretty detailed view into some of these exit transactions. I want to talk about three transactions that I think share a common theme that I'm going to develop as I go through the description. And these are these anecdotal observations. These are these things that I'm talking about which aren't statistically valid because there's not a database, but I think that there's still useful information that we can glean from what happened here. And one of the things that makes this work on exits very challenging is that very rarely do we get to talk about the transaction and the price. And the reason is that most of the time, the entire transaction is covered by a non-disclosure agreement. So most of the time, I'd say 80 to 90% of the time, when a company is sold, everyone involved signs an agreement that they'll never talk about what happened. And so we have, for example, some pretty good data now on investing in companies because there's no NDAs. Angels can get together and contribute to research studies like the one that ACA does with Willamette University, the HALO study. But we can't do that on exits because even if you wanted to share it, you'd be breaching a contract, you'd be liable for damages by not honoring that agreement that was probably signed not to disclose what happened. And so when I find a transaction where we can talk about the entire exit and the price, I get very excited. That's kind of a good year in my world of trying to learn about exits. Vineyard Networks is one of those examples. They were an OEM provider of deep packet inspection software. So they were watching what was traversing the internet, trying to understand what kind of data that was to help people who provide broadband better understand what was happening on their networks. And so they could do things like they could look into the packet stream and decide if you were browsing, whether you were sending an email or watching a video. This was based in Kelowna, BC, which is the interior part of the province where I live. It's actually a ski resort, but like we're seeing in so many parts of the world, entrepreneurship is alive and well everywhere. Anywhere people want to live, entrepreneurs are now building really interesting companies. They did 2 financings by angels and friends and family. They had raised about $1 million in equity, and they'd attracted about $350,000 of loans from local funds that support entrepreneurial organizations. The company was founded in August 2008, and in December 2011, they were about $1.3 million in revenue. So almost a prototypical angel-backed startup. And they were growing quite nicely, though. By December 2012, they were up to $3.1 million in revenue. And their first profitable year was 2012. So that kind of gives you an idea where the company was. And when they started the company, they actually did what most entrepreneurs should do, and very few actually do, is they had an exit strategy. Their plan was to sell the company for $25 million in 3 to 5 years. Maybe it's a little bit generic, but at least they talked about it. But after they talked about it, they never talked about it again, ever, until it was actually a reality. And they had quite a bit of active inbound M&A interest. They get phone calls quite often asking if they were interested in a transaction. And because of those inbound calls, they didn't take this buyer very seriously for the first few months. The buyer was a company called Procera. It's actually a Swedish company. And like a lot of companies, they thought that they needed to move their headquarters to Silicon Valley. They were, and that probably made sense because they did a NASDAQ listing. And so they were about a $60 million a year revenue company, NASDAQ listed. And they'd first approached the company about an acquisition in February 2012. Talks got serious by September 2012. They signed an LOI a month later, in October 2012, and the sale closed January 8th, only 4 months later. What's interesting about that is 4 months for a public company to acquire is almost unheard of speed. And one of the other takeaways here is how fast things are happening now. I sense a question over here. Yes? No? Question? No? So again, the takeaway here is public acquire 4 months from when things got serious. What was fun for me about this one is that the initial offer from Procera was $18 million. And this is where I had quite a bit of fun helping these entrepreneurs, is we had some very interesting strategy discussions about how far we thought we could push this buyer. And because Vineyard was in a good position and wasn't really, they didn't have to exit. They were in a situation where they would be fine, they'd be happy either way. Initial offer 18, I think a lot of entrepreneurs, a lot of boards would have been very happy to take 18 million. You saw what the last round valuation was. 18 looks pretty good. But we pushed back with a very definite, hard number. And we said it was $30 million, and we said it in a very firm, definite way to signal that if they didn't get much closer to almost double what they were offering, then there wasn't going to be a deal. The negotiations converged very quickly at 28 million. Like it was a matter of a few back and forth. 28 million, which was about 6 times revenue. Because this company, big smiles, I agree, huge smiles, 6 times revenue for this company that had just broken even. And that was a price of $3.14 a share Canadian. And the first angel round was at 36 cents. So that was almost a 10x for those angels. Everybody was very happy with that transaction. Just to end up on this story, it's not in the PowerPoint, but what's I think also interesting about this particular transaction, and it's very common in what I'm seeing today, is that I don't think this should even be called an exit. I think this should be called a really big financing for this company. Because what's happened since I actually built this slide is that the Procera public Swedish company has said to these entrepreneurs, you know, we really like what you're doing. We see that this is a good environment you're building this company in. We'd like to build a building over there, and we'd like you to double employment because we want to do more research here, and we want to build a bigger organization than the one that you started. So in terms of community impact, it's been enormously positive. It was perhaps the best thing that could have been imagined that could have happened to that company. Let me give you a different example of another company. This is a Vancouver company that had what I call a really early exit. This was a hardware company, and they've asked me to keep their information confidential still. They're under an NDA. Every year I get together with the CEO and try and talk them out of the fact that, you know, that NDA is kind of expired now. You know, we could probably talk about this. So far, I haven't got the story in a form that I can share publicly. But what I can tell you is that these entrepreneurs did what good entrepreneurs should do, is they wanted to follow the sort of lean startup methodology, the sell it, then build it philosophy. So they went and they called on some customers. And they said, you know, we're thinking about building this widget. Here's our target price. If we could deliver this, how many would you buy? Again, that's what entrepreneurs should do. What they weren't expecting was that pretty soon this company started to ask about buying their company. Not the product, but the company. And so the CEO called me kind of all out of breath and excited, you know, not really sure what to do. And to make a long story short, 3 months later, the cash was in the bank. So 3 months after calling on them to see if they would buy a product, they'd sold the company. And that company was still less than 12 months from startup, and they still hadn't launched the product. Now, what they did do that was smart is they filed a couple of patents. So when this medium-sized company saw the product and saw that they'd patented the technology, instead of buying this product, they did what so many medium-sized companies are doing today, is they just acquired the company. Here's another similar story. Local software company from my neighborhood. It just sold a couple of months ago. This company was also pre-revenue. And in this case, the software was still 6 months from beta. They could not even demonstrate this product. And these two entrepreneurs were experts in their field, but they didn't know anything about how to finance a company. So they thought, we'll go and call in a strategic investor to invest in helping us finish the software. So they went down to one of the larger companies in their market and they said, we'd like to raise some money to finish our software. And they only needed about $1 million to do that. And of course, we all know that they should have gone to angel investors because that's what makes more sense. But this larger company, again, no surprise, was not interested in investing. Very, very few companies invest in minority equity stakes. This was popular in the 80s. A lot of companies had venture capital arms. A few more do today. But the results of that experiment were pretty clear that big companies don't make good minority equity investors. They just don't know how to do it. It's not in their skill set. Sir?
Does that include what often are referred to strategic investors, where they want to hold a minority position, monitor it, and maybe see it as part of their corporate roadmap for technology and take a larger position? Do you include that?
Absolutely.
I would think you would say.
If you graph it over the last 25 years, it had a peak in the 80s. That was when strategic investment, corporations investing in startups was the most popular it's ever been. And then it went completely out of favor in the 90s and the 2000s, simply because after doing it for about a decade, the CFO in these companies looked at the results and they were terrible. Turns out big companies make really bad venture capital or angel investors. Now, what is happening today is there's a shift, and we talk about this in the Exit Strategies workshop. There's been a shift. In the last less than a decade, we are seeing quite a few big companies come back into early stage and venture capital investing. The only company that I know of that lasted all the way through was Intel. Intel had a venture arm in Oregon. It never shut down. And now we're seeing companies like Hewlett-Packard and some other really big companies come back in and start to make strategic investments. They're doing it because they really want some insight into what's happening in the innovation part of the economy. They're doing it as an experiment, as an extension of their R&D, as an early part of their corporate development. But from the company's point of view, strategic investors very, very rarely make sense. So these entrepreneurs made a classic mistake thinking that they would go to a strategic to get them to invest in a pre-revenue startup. I mean, the chances of that happening are astronomically small. But what was interesting was this big company was very interested in acquiring. So companies are acquiring more than they've ever done before. Buying 100% is what they know how to do. They buy it, and then they don't have to worry about all the things that angels worry about. They don't have to worry about governance. They don't have to worry about investment agreements. That's not what big companies are good at. But acquiring is a main part of most of their corporate strategy and tactics today. And so these two entrepreneurs sold their software company, and now they're very happily part of this larger company. And the common element in these three successful exits, all of these exits were in the category that I would call successful. They all got good prices. They were all happy after the fact. The common element is that these were accidental exits. At least that's what I call them. I'm not sure if there's a better term for it. But what I mean by that is none of these exits were planned. They all occurred by fortunate circumstance rather than by planning. And again, I want to remind you, we do not have the data. When I say a percentage like that, this is my anecdotal observation. I don't have a database to back this up. But based on my observations, I think about half of today's tech company exits can be characterized as accidental. They're completed more by chance than by design, more by serendipity than strategy and planning. Any questions on that?
On those last two companies, can you give any indication of the range of the exit, low seven figures, mid?
Low seven. Again, pre-revenue.
Well, on that Prospera negotiation, you're almost doubling the valuation. You said it was just a couple back and forth. Was it really just, here's our firm 30 million and then settle at 28, or were you, reminding them of their value proposition or all of that? I mean, it seems so easy.
I probably did make it sound too easy. And the hardest part was convincing the board, because very few boards have the courage. And more entrepreneurs will, especially younger entrepreneurs who, what the heck, let's give it a try kind of thing. But the hardest part is getting the boards to believe that the price is that elastic. And that was a harder negotiation than with the buyer. And then, yes.
Founding company.
Yes.
They didn't believe, so they thought, oh, you're risking it, we're going to lose the whole deal.
Absolutely. The bird in the hand was right there. $18 million. And going back, not just going back tentatively, oh, would you pay a little bit more, but going back and saying, look, 30 or we're not interested. And lots of times, if you misjudge that, the buyer won't be interested. And then if you have to go back, oh my goodness, that's a very, very weak position. So, first of all, understanding the value of that company, to really understand what price the buyer would pay. A lot of research into the buyer. A lot of research, not only into the corporation, it was public, so there was information you could get, but into the psychology of the individuals that were involved. A lot of interesting thinking and research and planning went into that, and a lot of rehearsing, a lot of practicing. A lot of CEOs, they can be all gung-ho and yes, we'll go back and ask, and they practice it a few times, get them out there in front of the CEO on the other side, and they go, we like it. They choke, and they can't get it out. It doesn't come out of their mouth because they can't say the words that they had agreed. So a lot of work. But in this case, when I say it was easy, in relative terms, sometimes that negotiation will take a couple of quarters. In this case, it took a couple of weeks.
Because there was no investment banker involved?
I was actually helping them to make that transaction happen.
On the third one, is that more would be classified now as acqui-hire? Were they just like these founders and wanted to acquire them and have them develop the product in-house?
Of course, there's no definition of an acqui-hire exactly, but they actually did like the product. Even though the code was not finished, they did a lot of diligence on the code, and they definitely are building on the product. So it wasn't a pure acqui-hire, but definitely had characteristics of being one.
Is there any simple observation of when having a strategic works? Or is it
almost never. Yeah.
And do those have anything in common with one another than 10%?
We should have a whole course on what's wrong with strategic investors. And you should follow the course on what's wrong with letting VCs follow on in our investments. And we do talk about that a little bit in the exit strategies workshop. And one of the things about the strategics is that 98% of the time they're going to impair the value of the company. People think about the operational benefits of having a strategic investor, but what they miss is the downside of trying to sell a company with a strategic investor. And the short answer is that if you've got a strategic investor in the company, any other potential buyer will automatically go through a thought process that goes like this. Number one, that strategic investor knows a lot more about that company than we ever will. Number two, we're probably being used as a stalking horse to get the price up that they're going to pay. So we're not going to invest the time because this is a futile effort for us. They've already got a relationship. Number three, if they're not interested in buying it, they know something that we don't, we're not interested in buying it either. So the small benefit of getting a strategic investor, getting their money, there's no shortage of money today, maybe getting some help from them, is by far outweighed by the downside of the inevitable reduction in the valuation that all of the shareholders will receive, because there's almost no way to successfully sell a company with a strategic investor. So my point here with this accidental exits thing is, just imagine how many we miss. I told you 3 happy stories. I could tell you many other stories that were not nearly as happy. And I can't do that because It just isn't fair to the people that were involved. They're just too sad. But these happen, I think, because the decision makers in these companies didn't really appreciate what was possible in today's M&A market. And this is certainly the hottest market that we've seen in at least the last 15 years. And we're seeing transactions complete in just 3 or 4 months. We're seeing valuations be very favorable to sellers. That's an incredible understatement, by the way. And transactions are happening every day that I would not have thought were possible 5 years ago. If somebody said to me, can we sell our company that's less than a year old, we don't have any revenue, I wouldn't have thought that was possible 5 years ago. But it's happening on a regular basis now. So I think, and part of my mission here is to help boards at least think about whether or not this might be the opportune time for them to think about an exit for a company. So these 3 stories all ended happily, but they are the exceptions. And they, I hope, illustrate to you just how fast and how active this current market is. But they don't adequately describe how fortunate these companies were. There's a lot of luck in those 3 stories. And it's incredibly risky because if you go forward in a situation like these 3 companies were in, with a single buyer, the probability of having a successful transaction is only about 25%. And again, I don't have the data to back this up. This is my observation. But I'd say that, about a quarter of the time do you end up with a happy result when you start with a single bidder. And the reason is that any single element can derail the transaction. There's 100 things that have to all happen for the check to get through the bank. And it's like a chain. If just one link in that chain is broken, that transaction is not going to happen. And so what I think is a far better strategy, and what I wish all companies did, is that the reality is that a well-executed, proactive exit process can get that probability of completion up from, say, 25% to maybe 75 or 85%. That's the difference between letting it happen to the company versus having it be a well-thought-out, planned process. And so I think all companies should have a well-thought-out exit strategy and plan. And we're going to be talking more about the plan part this morning than the strategy, but both are needed to get to the end result. So in summary, this is certainly the best M&A market we've seen for at least 15 years. Transactions are happening incredibly quickly at exceptional prices, and I think all companies should at least be thinking about it. And proceeding with one buyer is risky, but occasionally can produce a very good result. But again, my main message here is optimum exits require strategy and planning. Questions? Disagreement? Sir. Great question. So the question is, how does 2016 look compared to 2015? We're still at a very high level of activity. There's some indication that it's fallen off a little bit from the 15 level. So it's back to sort of the 14 level. But that level, if you look at it over the last couple of decades, is still several times more active. Valuations are still much, much higher. And it's really a simple matter of the fact that we're still recovering from the mortgage crisis. The Fed still has interest rates at the lowest rates of our lifetimes. And all of that is just capital that wants to move. In fact, if it doesn't move, the president gets on the phone and yells at the banks. And the whole financial ecosystem right now is awash in capital. And, we'll all know when that changes. It's going to take something big to change that. It's taken a long time to get us here. It's taken the Fed like almost a decade to build up this much cash. But, my sort of mental image is it's like a river flowing in the street of cash right now. So it's a very good time to be thinking about exits.
Would you characterize that awash in cash as cash on the balance sheet of companies, or just liquidity that's necessary because tenants are too big to fail? I think that matters, right?
It's all of those things. Today in the Exit Strategies workshop, we talk more about buyers. And corporations today have more than double the cash on their balance sheets than they had 10 years ago. And that's because when things got difficult in 09 and 10, they did what good corporations should do. They operated prudently. But in this pretty buoyant economic time, they're making high profits. They're putting a lot of cash on the balance sheet. And the shareholders as a group are very angry about this. And the shareholders at the stockholders meetings complain bitterly to the CEOs about all this cash sitting on the balance sheets. And the CEOs, almost to a man or a woman, are standing up in front of the stockholders and saying, we're going to do acquisitions. That's their answer. Sometimes the shareholders get mad enough and they actually end up having to dividend it out. They had to do that with Apple, for example. But there's just, it's on the balance sheets, it's in liquidity in the system. The easy way to see it is in interest rates. Look at what you're getting on your cash deposits.
Your guesstimation is on 25%, 50%. What is the circumstantial data that you're using for that? Is it that very Vancouver heavy? Is it Canada heavy? Is it US heavy in specific industries?
Good question. And again, we're talking about rough numbers here. It's a combination. It's my anecdotal observation. There is no data. I have the luxury of doing whatever I want to do pretty much these days. So I spend time talking to lots of angels and people in the M&A market, corporate buyers. And so this is kind of what I... No, it's mostly US. But it doesn't really change. This is a global phenomena. If you look at what's happening in Europe, they're in exactly the same situation as we are here in America. The only new thing is China. The only thing that's completely surprising in the last year or so, all of a sudden, because of the economic difficulties in China, the money is flushing out of China, and we're probably seeing Chinese M&A happen at about 10 times the rate today that it was 1 year ago. So if there was a story, and if we had the data, that would be the big story today.